I want to say a couple of things about diversification. Okay, we've all heard the concept of diversifying properly, right? The idea is not to put all your eggs in one basket. And what they mean by that, most of the time, is that you should have some of your money in stocks and some of it in bonds, and some should be in more conservative investments, and some should be in riskier investments. And the idea is to not have all your eggs in one place so that if the market goes down, you don't get killed, right? That's how we think about diversification most of the time. But once you retire, there are other risks that you need to think about diversifying against. You need to protect yourself. Those types of risks are called longevity risk. That would be outliving your money. Tax risk. That would mean having high tax bills in the future. And the third way would be called sequence risk. And that has to do with the order in which you gain or lose money in your investments. For example, if you were to invest your money in year one and the market went down 30%, well, it would be hard to make up for that kind of loss early in your retirement years, right? That's called sequence risk. If the losses don't come till later, you might be okay. But if they came early, it might totally change your retirement plans. Tax risk means, well, what if taxes go up in the future? Because once you're retired, your income's not going to go up to match. So if you have to pay a lot in taxes, that's going to hurt your retirement strategy. So the HECM is the home equity conversion mortgage. It's the acronym that they use to describe the government's insured reverse mortgage program. The HECM line of credit can help you diversify against those types of risks. Okay? The HECM line of credit is guaranteed to increase every year by whatever the interest rate is plus half a point. And you can use the money tax-free for absolutely any purpose. So let's say the stock market went down one year by 20 or 30% and you didn't want to pull more money out of your retirement account. You could pull the money out of your HECM line of credit instead. Let's say that you needed to replace the roof or come up with a chunk of change all at once. Well, instead of taking it out of your IRA or your 401k, where you'd have to pay taxes on those withdrawals, you could pull the money out of your HECM line of credit tax-free. See, there are a lot of things that you can do with a HECM line of credit that can help protect your retirement going forward. That money in a HECM line of credit can never be canceled. Unlike a HELOC, home equity line of credit, where the bank can cancel it anytime they want to, the HECM line of credit is guaranteed to be there for the rest of your life. There's nothing like the HECM line of credit in terms of diversifying your risks when it comes to retirement savings. And if you need to know more, and I think you do, send me an email and I'll put together a pretend reverse mortgage. It'll look just like a real one, except it'll say pretend all over it. And that'll give you an opportunity to kind of look under the hood and see what it's all about for yourself. Don't believe the rumors. They're not true. There's absolutely nothing wrong with the HECM program. It was created by Congress, it is regulated by HUD, and it's insured by the FHA. It's certainly not a scam, right? Those are just things you hear on the street. Get a pretend reverse mortgage today and get to the bottom of it yourself. You'll see that a HECM reverse mortgage is just a mortgage. The difference is you control the mortgage instead of the mortgage controlling you. You make payments when you want to, you skip them when you want to, and it's perfectly okay. All right? Send me an email. I'll get back to you right away. We'll put together a pretend reverse mortgage and go from there. If it makes sense, I can help you. If not, at least you'll know the facts. All right? Thanks for watching.